Many Australians pay a tax they could easily have avoided, the Medicare levy surcharge. A new report shows hundreds of thousands are hit, often paying over $1,000 extra in tax. The worst part? It isn't withheld from your pay. It's a surprise bill when you file your tax return. This isn't bad luck. This is the result of 8 common and often counterintuitive errors. In the next few minutes, we'll break down every trap so you can make sure you're not next. First, what is this surcharge? It's not the normal 2% Medicare levy. It's an extra 1% to 1.5% for high earners without private hospital cover. The trigger is your income. For the 2025 to 26 tax year, it starts at $101,000 for singles and $202,000 for families. Crossing a threshold can suddenly make you liable. This leads to error number 1. Assuming any private health insurance will do. Your extras cover for dental or optical does not exempt you. Only an eligible private hospital cover policy saves you from the surcharge. This distinction trips up thousands of people every year. But even with hospital cover, you can get caught. Error number 2. Your policy's excess is too high. It must be $750 or less for singles, $1,500 for families. Why this rule? The government wants to ensure people have usable insurance that takes pressure off the public system, not just a policy to dodge tax. So your action here is to check your policy documents right now. Don't assume, verify your exact excess amount. Error number 3 is a timing mistake, not having cover for all 365 days. The surcharge is calculated daily, so even one uncovered day costs you. And error number 4 is believing you can fix this later. You can't. Buying insurance in June doesn't erase the surcharge you incurred from July to May. Error number 5 is assuming the basic Medicare levy already covers your insurance obligation. Wrong. It's completely separate from the surcharge, which applies to higher income earners. So you checked your insurance. It's hospital cover, low excess, held all year. Why could you still get a massive tax bill? The answer is in one of the tax system's most misunderstood parts, and it's our error number 6. What the ATO considers income isn't what you think. Your income for MLS purposes is not just your taxable salary. The ATO adds back several items, pushing you over the threshold unknowingly. This includes fringe benefits like a company car, salary sacrificed super, and net investment losses. Yes, a loss can increase your MLS income. This is why you get a bill when you think you're safe. You calculate on salary. The ATO uses this broader, higher figure. Now let's add families to the mix, which leads to error number 7, the family income test. For the MLS, your income is combined with your spouse's income. And it is not just the parents. Every single dependent for MLS purposes must be covered by an appropriate hospital policy. One child uncovered, the family pays. This creates the 8th and final error, not realizing that for MLS purposes, a specific definition of dependent is used, which catches adult full-time student children to age 24. Recall the expanded income definition and the dependent rule? The ATO's data matching is very accurate. You're hit with the full family surcharge. So let's review the main traps. Having the wrong type of insurance, misunderstanding what counts as income, and mismatches in family cover. Why the urgency? The ATO is aggressively ramping up its data matching program. They compare health fund data directly against your tax return. Here's the final vital point. For most people liable, the annual cost of a basic, eligible hospital policy is less than the MLS they would pay. Remember that $1,000 average bill from the start? You can pay that to the ATO for nothing, or pay less and get actual hospital cover. So what do you do now? 3 simple steps. 1. Review your health insurance policy document. Check for hospital cover and the exact excess amount. 2. Calculate your income for MLS purposes. Don't just look at salary, add back super salary sacrifice and other items. Use the calculator at the taxrates.info website. 3. If you have a family, confirm your policy covers every single dependent you claim on your tax return. A single policy is not enough if you have kids. This can get complicated. To be sure of your choices, always speak with a tax agent or financial advisor. One last tip. The family income threshold increases by $1,500 for each dependent child after the first. A small detail that could save you. The Medicare levy surcharge is designed to be a choice. Get private cover or pay more tax. Errors can turn that choice into an expensive penalty. By understanding these 8 traps, you're now equipped to make an informed choice, not an expensive mistake.